exactly like this. It'll be structured in this order, but it might be broken out a little differently. Intangibles might include things like patents, trademarks, those types of items. Might include something called goodwill. We'll talk a lot more about goodwill as we go through the class. But those items that are not, you can't pick them up, you can't hold them. They are intangible. All right. And that'll sum up to total assets. And again, on the right side of the balance sheet, we're going to have liabilities and stockholders' equity, how these assets have been financed. All right. First thing we'll have up here, we'll have our current liabilities. We might have AP or accounts payable, money we owe to our vendors. We expect to pay them within a year. Might have accrued liabilities, vacation payable, salaries payable, dividends payable, those types of things. We expect to pay those things within a year. Might have something called CP/LTD, current portion of long-term debt. Anytime we're trying to calculate a company's debt level, some of that debt might be due within the next year, so it would be classified as part of current liabilities. We need to include it in debt. All right. You might also have short-term borrowings, maybe a line of credit, maybe a revolving line of credit. What's a revolver? It's kind of like a credit card for a company. Okay. As they need cash, they can borrow on it. As they have excess cash, they can pay it down and then re-borrow. All right. So think of a revolver like a credit card for a company. It is also debt. All right. So anytime we're summing up our debt, we'd want to include any short-term borrowings, any current portion of long-term debt that are in current liabilities. All right. These would be summed up current liabilities. Then we'd have long-term liabilities, typically long-term debt, bank debt, bonds payable, capital leases, those types of items. All right, so in this particular company, if I wanted to figure out what is their total debt, I'd want to add current portion, short-term borrowings, and long-term debt all together. Okay, and you'll see that in your homework. You'll see that over and over as you look at different companies. Make sure you include all different types. All right, and then we might have total liabilities, and then down here we might have shareholders' equity. Just going to abbreviate. Things like common stock, retained earnings. What's retained earnings? Basically the cumulative earnings or losses over that company's history that they've kept in the business that they haven't paid out as dividends. All right, so every year you get to a company's bottom line, they've got net income. If they keep it all in the business, that is, they don't pay any out to its shareholders as dividends, it gets quote unquote reinvested into company's retained earnings. All right. You'd have total equity, total shareholders' equity, and then you'd have total liabilities plus shareholders' equity, which needs to equal total assets. Okay. Balance sheet must balance. Cardinal rule of accounting. Okay, we'll use that, that relationship when we get into building a financial model. Okay, we build our model. If our balance sheet doesn't balance, then we're not done. Okay. Any questions on the balance sheet? I know this is remedial for a lot of folks, right? But I do want to make sure everybody understands all these components. I don't want anybody to be surprised when we start picking up the pace a little later on. All right. Sometimes in shareholders' equity, you might also have treasury stock. The company goes back out in the market and buys shares back. That would be in treasury stock. All right. Sometimes you see that happen as well. All right. Some key considerations on the balance sheet. A lot of times you'll be asked to calculate what is the company's working capital position. Okay, and that's calculated as we have up there, current assets less cash, all right, less current liabilities net of its short-term debt or its current debt. Okay, basically, if the company were to liquidate its current assets other than cash, receivables, inventory, et cetera, if they were to turn those into cash, how readily could they satisfy their current liabilities? Okay, and a lot of times for retailers, cash should be in, cash is needed to finance the business. Retailers have to keep cash in the drawer. They've got to buy inventory. All right, so it's a key component of working capital. Also looking at balance sheets from period to period. So last year at the end of the year to this year, what is, has their debt level changed? If so, you want to figure out why. Has the company engaged in an acquisition that they financed with debt? Have they recapitalized? Maybe raised some debt to pay dividends? Right? Have they had to engage in a lot more short-term borrowings to fund working capital, that type of thing? Also, changes in shares outstanding or changes in the equity accounts. Maybe the company's engaged in an acquisition where it paid for part of that acquisition by issuing shares. All right? Another way a recap could work is they could issue stock to pay back debt. All right? They could raise more equity. A lot of companies are looking to raise equity right now, all right, to de-lever or pay down debt on their balance sheet. A recapitalization. Maybe they've bought back shares like we've talked about before. Maybe they've done a secondary offering, right? They've gone back out to the market, issued additional stock, that type of thing. When we talk about the income statement, we're talking really about how profitable has the company been. Does anybody need this still? I'm going to take this down. We're talking about to what extent has the company's revenues exceeded its costs. When companies announce earnings, they're usually talking mostly about the company's income statement. How were their revenues for that period? How were their costs? How much flowed to the bottom line? What was their earnings per share? Those types of things. And an income statement is typically structured where the first line is something we call revenues, sales. What has the company brought in by selling its products or its services? What do you typically see next? We typically deduct something called cost of goods sold, sometimes referred to as COGS. Basically, what was the cost directly associated with the products or services that they sold? Right? If we're selling shoes, what was the cost of the materials? What was the cost of the labor to stitch those shoes together, etc. Okay. When we deduct cost of goods sold from revenues, we get something called gross profit. All right. The higher the gross profit relative to sales, the better. From gross profit, we typically deduct something called SG&A. What's SG&A? Selling, general, and administrative expenses. All right. All those items that are not directly related to each individual pair of shoes that are sold, right, but items that are part of our cost structure nonetheless. Salaries, benefits, okay, the CEO's $10 million salary would be in there. Travel, entertainment expenses, marketing expenses, advertising. Might have some non-cash expenses, depreciation, amortization expenses. We're going to talk about those in a moment. All right, but all those items you can't attribute directly to the sale of one or to the manufacture or sale of one particular product. All right. If we deduct SG&A from gross profit, we get something called operating income. It's another way of saying operating income. It's an abbreviation for that. Not OI. There's another abbreviation we use. EBIT. Operating income is synonymous with something we called EBIT, earnings before interest and taxes. Really important concept in finance. All right, the income that the company has generated from its operations. All right. So EBIT, I will draw a line here. Basically, everything from EBIT and above, what we call related purely to a company's operations. Okay, it's before interest. What's interest related to? Debt. Okay, debt is a part of a company's capital structure. So earnings before interest and taxes relates solely to the company's operations before we consider the company's capital structure, before we've considered how that company has chosen to finance itself. All right, because it is before interest, we would call all of these items up here unlevered. Okay, leverage is something, it's a term we use to describe the relative proportion of debt that the company has in its capital structure. When we get into valuation tomorrow, these terms will be very, very important. Finance theory tells us if we're going to value a company, we need to be blind as to how that company has chosen to finance itself. And that's where this EBIT and that's where these items above the EBIT line come into play. We're not considering financing, we're not considering capital structure, we're not considering leverage. Okay, we'll come back to that over and over. I did want to introduce the concept today. Okay, what's another thing that EBIT relates to? What's another thing we might calculate using EBIT? Anybody ever hear the term EBITDA? EBITDA, EBITDA. If we take a company's EBIT and we add back something called depreciation and amortization, oftentimes referred to as D&A, we get a concept, we get an item that we refer to as EBITDA. Okay, EBITDA is not an accounting term. You're not going to find it if you open up the Heinz financial statements. You're not going to find EBITDA. Okay, you probably won't even find EBIT. You'll see operating income. And if I'm asking you what is EBIT, you know that EBIT and operating income are synonymous. But you will not see EBITDA. Right? Why do we calculate? Why do we add back D&A, first of all? What are depreciation and amortization? They're non-cash expenses. Okay? Depreciation relates to the company's, typically to its physical plant and equipment. Okay, so if it owns a building, that building will have a useful life for accounting purposes, over which the company will depreciate that building. If it's a 20-year life, they'll depreciate that building over 20 years. If they buy a computer, they'll probably depreciate that over a much shorter useful life, because these things don't last very long, probably 3 years, maybe less. All right? Where those depreciation charges will show up, sometimes they'll show up in SG&A. Sometimes they'll show up in cost of goods sold. Sometimes, not always. Okay? But they might be in both places. Depreciation specific to the equipment that was used to manufacture the shoes. Specific to the plant in which those shoes were manufactured, that type of thing. Okay? But a lot of times these items aren't broken out. Okay, so we need to go and we need to find them elsewhere. Many times you won't see any depreciation or amortization on the income statement. Anybody know where I'd find it?
Balance sheet?
There might be a line in the balance sheet called accumulated depreciation, which will be all the depreciation since those assets have been on the books, but it may not give us the amount specific to that year. Where you need to look to find this, and I'll lump amortization in here as well. Where you would find this is on the cash flow statement, which we're going to talk about in a moment. All right. So EBIT, we get off the income statement. D&A, we get off the cash flow. We add them together to get to something called EBITDA, which I still haven't told you why we do that. What is EBITDA? Why do we use it? Anybody know? EBITDA is oftentimes used as a quick and dirty proxy or an estimate for cash flow from operations. How much cash has the company generated from its operations? Okay, so we take EBIT, which is its operating income, the income on its operations, but because some of the expenses that we've deducted to get to EBIT are non-cash, we add them back. All right, so that delivery truck that we bought 5 years ago for $20,000, we're not writing a check every year for the depreciation. The depreciation is really kind of an accounting allocation, an apportionment of value to each individual year of that vehicle's useful life. It's non-cash. Because EBITDA is a proxy for cash flow, because we're trying to figure out what has the company generated in cash from its operations, we add those non-cash items back. Does that make sense so far? I know I'm throwing a lot at you. This will come back tomorrow. We'll spend a lot of time with EBIT, with EBITDA. I did want to point them out. We'll especially spend a lot of time with this concept of levered versus unlevered. For now, just recognize everything EBIT and above, unlevered. Not dependent on how much debt the company has. Any questions on any of this? Amortization, I don't think I defined. What's amortization? It's like depreciation, except it's relative to a company's intangible assets. All right, maybe it's patents, maybe it's trademarks have a useful life. We would take a non-cash charge, same concept as with the physical assets or as with the depreciation, non-cash charge, but it's related to the intangible assets of the company. All right? So again, everything EBIT and above, unlevered. We calculate EBITDA because it's a proxy for cash flow. EBIT is calculated by taking our EBIT or our operating income, adding those non-cash charges, which we get off the cash flow statement, which I'm going to talk about the cash flow statement in a moment. All right, that's clear so far? What comes after operating income? What comes after EBIT in our income statement? Well, it's after that, but what is the next item? Interest. Earnings before interest and taxes. Now we have to take into account interest, then we'll take into account taxes. All right, so interest is deducted from operating income, interest expense, which would give us earnings before taxes, pre-tax earnings, earnings before income taxes. They might be phrased differently from company to company, but they mean the same thing. The earnings of the company before we pay the government. Make sense? Last item we need to take into account then is Uncle Sam. Pay our taxes, and then we'll get net income or net income after tax. Usually the last line in our income statement. Sometimes you might see a further distinction down here. If a company's discontinued some operations, right, maybe they've sold off their ketchup division because it's not making money. A lot of times what they'll do is they'll separate this into two components. They'll separate it into income from continuing operations and income, and then they'll have income from discontinued operations as well. All right, if you see the two of them, you want income from continuing operations. All right, I know I'm abbreviating there. Income from continuing operations. When we look at companies, we want to analyze them based on what does the company look like now on a sustainable go-forward basis. So that income from continuing operations will give us a sense of what is the income from the assets and lines of business that we expect the company to have going forward. I'll come back to that tomorrow. That'll come into play in tomorrow night's homework, but I did want to introduce the concept now. One other thing I want to talk about relative to income statement is I want to talk about the concept of latest 12 months. Latest 12 months, you might hear it referred to as trailing 12 months, might be called LTM, might be called TTM for trailing 12 months. Basically, what has the company done on a rolling 12-month basis? Maybe it's revenues, LTM revenues, LTM EBIT, LTM net income. Right? Why would we look at LTM? Why would we need to calculate this separate from just opening up a 10K or 10Q? Well, what if we're analyzing a company kind of in the middle of their year? All right, all we have, let's say we've got a company, okay, this is 08. So this is 3/31/08, 6/30, 9/30, 12/31 of last year. Okay, and right now, let's put up 09 as well. Okay, 3/31, 6/30, 9/30. Companies that are on a calendar year fiscal, the latest statement that they've filed is probably a 10Q for the 9 months ended September 30th of 2009. All right. It's probably the latest piece of information that's available to us. Well, that only gives us 9 months. Okay. We want to look at the company, though, on a full year basis. We want to know what have they done for the last 12 months. The only 12-month statement that's available to us right now is to go back to that company's 10K for 2008. All right, but that is now 9 months out of date. Okay, 9 months, a full 9 months of operations have elapsed since that's been filed. A whole lot could have occurred between those dates, right? So what we do is we use a combination of that 10K coupled with this year's 10Q to figure out what are company's results of operations for that entire 12 months or LTM period. Company. But there is no financial statement that will give us this on its own. 10K gives us the last 12. Most recent 10Q gives us the last 9. We actually need to use a combination of these two to get to this LTM period. All right, so let me illustrate that mechanically and show you how that works.